All right, everyone, welcome to CRE's Dirty Dozen, being presented by Rhenium Capital. My name is Michael Jimenez. I'm a founder of Rhenium Capital. I'm here with my partner and co-founder, Andre Quadrado. We're going to go through the list of who we think or what we think are the 12 riskiest deals in commercial real estate today, hence the title CRE's Dirty Dozen. We held a contest. Again, thanks everyone for signing up so quickly. We filled up the room in one day, which is great. We had a contest as well going. Whoever could name the tenant type or deal type or industry type that got the number one spot on our Dirty Dozen list, they would win a free report. That offer still stands. We'll check the email before this is all over. But we wanted to do this because we see a lot of these kind of risky assets. We've seen a lot of them. We know they're not common for everyone else. Unfortunately, I've seen them more than I care to admit, and they're pretty common. So we wanted to kind of shine some light on what we think are really risky deals.
Okay, everyone. So first up on our Dirty Dozen list is gyms. We're not referring to the big guys, the nationals that are actually expanding, like the LA Fitnesses or the 24 Hours or the Planet Fitness type tenants. We're talking about more of the local or regional guys. Um, the non-credit small guys. If you become a member, you don't have the benefits of being able to travel city to city and utilize gym services. Um, Generally speaking, they'll be in usually older and larger spaces that may not drive that much traffic to them in the first place. The real big risk we see with these guys is, generally speaking, the business does not own the equipment, the free weights, and the cardio stuff. They either have a loan on the equipment, a separate business loan, or they generally lease it. So the problem with that, coupled with the fact that they're usually opaque on their sales, could make this business literally disappear overnight if somebody happens to foreclose or repossess their the equipment that actually keeps the business running. And that is a problem because you have generally, for all gyms, you have generally cyclical sales where a lot of the new year, new you guys are going to be popping up and popping in, swearing that they're going to be using the gym all year. And then around March, mid-March or so, that generally tends to peter off. So again, we want to touch on saving graces even on the most risky deals that we see. The large national guys, and some of the newer guys like the Orange Theories and the UFITs, they have a great model. They're backfilling some of the tougher spaces like the old blockbusters, and they're actually doing really well attracting young professionals to their sites. So, again, we just want to really stress that the local or regional non-credit guys are one of the riskier deals that we see.
All right, number 11, golf courses. So there's, basically two kind of courses, good golf courses and bad ones. The good ones are, the number one thing you're going to look is a strong location. Um, Location is everything. It's going to really show you who you're near. You want good demographics, economics, be close to. Another important thing is complementary amenities. You want a solid location near complementary amenities, whether it's an attraction like a beach or a park, or a mall, or just really high income area. Being close to something in a good location is extremely important. You're also going to want to look for other forms of income at the property other than just membership dues and greens fees. If they have a restaurant attached, you want to make sure you check out their food and bev. Um, but you want to make sure you have multiple drivers. Like I said, if you're attached or close to something that can generate traffic for you, that's great because you want a reason for people to come there. You want a reason for them to stay there as well and spend their money, obviously. So a good golf course is going to have, as much of that as possible. They're also going to have typically a really good, solid reputation, or they're going to be backed by a big name or some form of brand name. Whether it's I think Trump has the Green Monster here in South Florida in Doral, which everyone's aware of. which everyone knows. You could be a Nick Loss design course, or you could be a course that's on the PGA Tour. So something that's kind of setting it aside from its competition. The issue with golf courses is the exit is really tough. So if you have some of those, I would say those top three things: you're in a good location, you got big name, or good reputation, and you've got complementary amenities to help you generate revenues. You're usually going to be a good location. Your exit should be easier. You could sell the business for more if it was managed well. If you don't have those things and you don't have an income, you're really looking to develop either part or the entire parcel of the golf course, and that's really going to be your only exit, which is why they can be really tough if they're not managed well and not in a good location.
Okay, next up we have number 10. This is vice tenants, which, I'm sure nobody is really surprised by this. We're talking about the bars, the nightclubs, to a certain extent, the pawn shops and the liquor stores. Anything where there's alcohol consumption or even alcohol sales definitely attracts a certain layer of chaos to an investment. Um, Looking at it from an investor perspective, if people are on your property consuming alcohol or after hours, there's a saying that nothing good happens at 2 a.m. A lot of times that can be proven true. And the problem with that is if something happens and somebody's injured on your site, they could go after the club and sue them for not providing sufficient security. And then they can sue you as the property owner, or you sue your borrower for not having sufficient CCTV cameras on site to prevent anything like that happening. And at the end of the day, they're the personal injury attorney's dream. So, there's good sides to vice tenants. They can be great tenants. They can be great, I guess, business borrowers to a certain extent. If it's run well, they're going to have high-end build-outs or at least very specialized build-outs that's going to keep them in your center. So if it's run well and they're paying you at or above market rents, which is very common, given the liability that goes hand in hand with it, they can be good tenants and they can be good long-term tenants. But again, see the 80-20 rule in that case.
All right, number nine, churches and religious organizations. Um, the number one risk really is headline risk, both to you as the investor or potentially lender. No one wants to foreclose or evict Jesus or evict a church or shut down bingo night, right? Because someone's not paying the rent or paying their mortgage on time. You're never going to look like the good guy in that situation. So immediately, you've got to deal with that issue if anything goes wrong. Then there's also headline risk to the organization itself. And that the trinity of the organization, its leadership as well as its members. Um, you know, you don't have to search too hard to find headlines of someone related to some sort of religious organization does something crazy in the news, which is great for the news, but as an investor, as a landlord, or again as a lender, you don't want to see your tenant on the news, whether it's a church or anyone. So you got headline risk kind of on both angles there, right? The good news is there are a lot of very well run, very I guess you could say, financially strong religious organizations out there. And if they are well run and they do have a good balance sheet, they're going to have the paperwork to back it up, and as well as probably numbers on their membership to how many people they have, and they're going to know kind of who they are, what neighborhoods they're from, and exactly why they want to be in your location as well. If they don't really have a plan and they don't have paperwork to back it up, they're going to be probably on the side of the kind of organization you may want to consider doing business with. Um, the other downside to churches and religious organizations, the assets, if they ever have to be sold, it doesn't necessarily mean liquidation or anything like that, but it is can be pretty tough. You're usually taking a hit on book value, right? Unless I can put another user of this property into this building that can generate the cash flow or have the highest and best use that they had, it's not going to be worth as much to them. So they're usually going to take a markdown on their books. That's number one. Number two, it's pretty tough to backfill a church. And they also own a lot of different kind of properties. Typically, churches and religious organizations will own lands. I've seen them own daycare centers, campgrounds, gymnasiums, schools. I mean, you name it. A lot of people will donate property to them, and that's a lot of times how they end up with it. So their saving grace is, I would say, well-run organizations, with the paperwork to back it up, can breathe life into news centers. If you've got a vacant anchor that's been sitting for 5 years and a good religious organization comes by, and they kind of represent themselves well and they have good books and everything, it can be a plus for your center. So that's number 9, and that's the saving grace.
And number 8, we have dry cleaners. We're starting to get to the dirtier part of the dirty dozen here. Very common to be contaminated. We're talking about on-site dry cleaners. And, if anybody is not aware of the issues that come hand in hand with on-site dry cleaners, we can definitely clear that up with you very shortly. 3/4 of dry cleaners use PERC, which is a chlorine-based cleaning solvent that has, there's studies that say it's likely carcinogenic to humans. It's kind of a little bit further down the line than likely. And there's a few other issues with it. It can permeate through concrete. It can leach through pipes. And it definitely finds its way into groundwater and can plume out to other parts of your property and lead to vapor intrusion as well. And it can actually plume out to adjacent properties or municipal land and definitely cause significant issues with liability. There's been studies done that state up to 95% of the guys which was the 3/4 of the dry cleaners, are actually contaminated, which makes a lot of sense given how permeable this substance actually is. If it spills when they're loading up the machine, and a lot of times as well, they have waste sections where they keep the stuff in barrels to be shipped out and disposed of as well. Cleanup for this is pretty expensive. We used a pretty interesting picture here of a phase 2 report being conducted where they're drilling down probably about 18 feet to see the extent of the contamination into the groundwater. If there's a large plume, and often there is, especially if the water table is a little bit more shallow, then someone's going to have to come in there and cart away a large amount of dirt and replace it with dirt that is not contaminated. So obviously there is significant risk to the downside there. For the saving grace, a lot of them nowadays are just drop off, where it's a very similar format that's client facing, where they drop their stuff off and they have the rotating racks. But the clothes are actually taken out by truck, shipped off to an industrial area that's safely away from your retail property, cleaned and brought back, and it's usually pretty quick. Also, there's a few new ones coming out, like down in South Florida here, we have a company called Oxo that I personally use that uses biodegradable and non-carcinogenic chemicals, which arguably clean almost as well as PERC does. Next.
All right, guys, number 7, assisted living facilities, ALFs. The first thing to recall or think of with ALFs is the money's in the management, not in the real estate. The owner or operator of the facility, they're usually in the business of caring for the elderly, caring for their clients. They're not in the business. They're not real estate investors typically. If they're an owner user or if they're signing a lease, you want to make sure they've got the cash flow to pay the bills, right? To pay the mortgage, to pay the rent. So you're definitely going to want to look at their books. You're going to want to know a little bit about what other properties they own, how are they as a manager, et cetera, et cetera. If they're not a good manager, then that's kind of, issue number 1, and, you may not want them as tenants or as people, managing the operations of your investment. Number 2, the building, you want to make sure that it's a good building, and obviously it's built well and everything. but that it can hopefully be converted to another use, right? What if the ALF doesn't work out? What if they don't renew their lease, or what if they don't manage their operations well, and you want to sell for your exit? If it can't be readily converted to another use, that is a huge issue, and it's going to probably lead to either you trying to find another ALF to put in there, or trying to redevelop or something like that. So you want to make sure that you can use it for something else like multifamily, hospitality, or something other that can generate that cash flow. Otherwise, you're going to be looking to take a loss. Um, uh, and I would also say if you're looking for properties and maybe, hey, it's a good manager, I don't think it could be readily converted very easily, but I'm in a really good location with very strong demand factors, proximity to economic drivers, ease of access, etc. Um, then you're probably going, just keep in mind, you're probably going to be looking to exit more than likely at the end if you can't get another ALF in there.
Next up, number 6, we have freshwater marinas, and this may be a little bit foreign to people, but we've actually seen quite a few of these over the years. And as a matter of fact, we just took a look at one about 2 weeks ago as well, out in the Midwest. And therein lies the problem with these things. Most of the time, they're in rural locations, and most of the time, they're usually fueled by vacation homes. And it's no large leap of logic to realize, and especially looking at these things throughout the country and for the past couple of years, a lot of these vacation home markets were overbuilt and have not recovered still. So obviously the freshwater marinas haven't recovered either. But the main issue with these guys, and the reason why they're more risky than, I guess, a mass vacation home investment, is they're a large contamination risk, and it's definitely something that's important for you to consider. They are going to have an underground storage tank or an above ground storage tank or both on site to fuel the boats. And quite often they'll also have an area for boat repair and maintenance as well, which all of which can lead to petroleum or heavy metal contamination. Now, the big problem with that is the fact that it's fresh water. It also makes it very likely that this is somebody's potable water source, whether it's the vacation homes or the nearest town or maybe even the nearest city, like a Lake Lanier, which feeds drinking water to Atlanta. Another risk is, although it's not nearly as prevalent and as risky as the contamination, is the fact that a lot of these guys usually don't own the boat slips. It's not going to be part of the collateral. It's usually a lease to the Army Corps of Engineers to have access to the water, but it's definitely less of a risk than contamination. So the saving grace at the end of the day on these, and it might be a mid to a long term saving grace, is it's waterfront property, and there's intrinsic value in that no matter which way you slice it. So possibly, when vacation homes totally recover in rural locations, this would be the prime real estate that they could be built on. Next slide.
All right, number 5, gas stations. I love this picture, by the way, because you can zoom in right on the caps to the UST, the underground storage tank, and that's really the number one risk with gas stations, or those underground storage tanks, leaking underground storage tanks, lusts, as well as overfill and overspill, which are fairly common as well. All will lead to contamination. Contamination is the number one issue with gas stations, and I would say the number 2 issue. So let me keep going with that. So you're going to want to make sure that's in regulatory compliance. It should have. There's a lot of stuff that your federal, state, local governments will require from operators in forms of compliance, and you should be able to find out whether the tank is in, what kind of shape it's in, when it was installed, when it was lined, what kind of leak detection system it has in place, everything like that. So you got to figure out, how do I keep this tank from leaking? Has it leaked yet? And you got to get, at the very least, HDR, historical database review, or phase 1 report. Otherwise, don't buy one. Don't buy one without a phase 1. That's number 1. Number 2, the overall risk with gas stations is they're usually small money deals. They're usually $1 million or less. A majority of them are $1 million and less. I would say then you're going just right down the line, less than a half million, less than a quarter million, and there's a ton that are under a quarter million. Make sure you get that phase one in, because when you're doing a small, quote unquote, small dollar deal, I know it's a lot of money. Hey, it's a lot of money to me. It's a lot of money to a lot of people, right? The downside is damn near endless. If you have a groundwater contamination and it seeps in, if it plumes and hits adjacent areas, it can cause the liabilities is huge. Okay, so that's why gas stations are number five, because they're usually small dollar deals with unlimited downsides because of contamination. The next part is the operator has access, and they're the ones operating. Make sure you get with a good operator. Make sure you see the numbers, the sales, C-store sales, gallons of gasoline sold, as well as the profitability. Whether they're selling, ask if they're selling tobacco, lotto, and alcohol, or can use electronic gaming machines, and get the paperwork to back up everything. The saving grace, they're in usually great locations. That's the saving grace. You can buy a gas station for $100,000, $250,000. You can run it very well if you got a good operator, make some good money on it, and then you can sell the land, hopefully for redevelopment. They usually have pretty decent zoning too. Look for the traffic counts, look for the easy access, look for the record keeping and the environmental compliance, as well as the operations of the store.
Next up, number 4 is unflagged hotels. It lost its flag for a reason, and yes, the Bates Motel is the story of an unflagged hotel and some of the things that sometimes go on premises. Once the flag goes, your national support's gone. You lose your point systems. You lose your marketing. You're off a lot of the websites that promote your hotel. When that goes, obviously the income goes and the value drops. And we've seen a lot of these. We've seen value drop anywhere from 40 to 75%. Actually, I'm looking at one in Georgia right now that traded for 70 some percent less than what the last trade was when it was flagged Motel 6. When all this happens, the crime element comes in. It becomes an attractive nuisance, and cop cars start showing up quite often to your manager or your borrower's hotel. It's an issue, and it can snowball really quickly. One of the things that we do, and it's a very simple and very odd rule of thumb that a lot of folks don't look at even when they're digging through star reports and financials. Read the reviews. Get on TripAdvisor. Get on Google Reviews. You will see, of course, every hotel is going to get a bad review, but if you see a pattern of a lot of the same things going on for a very long period of time, if it's an unflagged hotel or it is a flagged hotel that has that history, it's probably going to be an unflagged hotel soon. Things to look out for, obviously crime, loud noises, people climbing in windows, but then very telling things such as bed bugs or most importantly mold or mildew smell in the rooms. So, the saving grace on these is, hey, these hotels, they're going to be by drivers and they were built there for a reason. Generally speaking, with competent management stepping in with significant capital to put in and fix this thing up, they can reflag it relatively easily. And the franchises, they're great. The IHGs, the Wyndhams, they're great because will inspect the property and come with a PIP, which will basically be a laundry list of all the items that somebody needs to step in and fix in order for the hotel to get its flag back. But this absolutely earned the number 4 slot on our Dirty Dozen list.
Number 3 on CRE's Dirty Dozen, The Walking Dead of Retail. This is what we received the most guesses for. It's you wouldn't be surprised if you turn on the news any day of the week and you found another retailer went under. They're constantly missing their earnings forecasts. They're going BK. They're shutting down stores or shutting down entirely. Just over the past few weeks, I think we lost 3 or 4. Aeropostale, Sports Authority, and then Gap got downgraded, I think, to junk status, I believe, and then Office Depot and Staples. It was Staples, right? Staples. They're just trying to survive, and the FCC shut them down for a monopoly on selling staples. It's like, come on, man, really? Like, they can't get a break. What killed the retailer, right? Why are they the Walking Dead? They're like zombies, right? Most of them just won't go away. Um, Obviously, internet shopping did, but modern logistics, Walmart. Think of Walmart. Their logistics systems is awesome. I love Walmart. Just for the record. Um, Modern logistics, fast fashion, other concepts, discount retailers like Ross, right, and Marshalls, and other concepts that essentially killed the traditional concept of these retailers, which is basically big store with big markups, right? Chinese markup trick. They're ordering stuff from Asia, usually clothing or cheap merchandise, and they're marketing with 10 and 20x multiples, and then marketing the hell out of themselves, out of their brands, out of their sales, and then getting folks to turn up and overpay for stuff, and hopefully they sell half their stuff, right? And then the rest goes on sale. Um, that model's quickly going out the window, and you got to offer the consumer a more engaging process, or you got to sell better goods, or you got to come up with another retail concept like fast fashion. Forever 21 is a great retailer, H&M, and the bad news is it's going to get worse before it gets better with a lot of these retailers. I think some of them are going to change up, and they already are changing up their business plans. Obviously the ones in the best locations with the best demos and access and incomes surrounding them are probably going to last the longest or do the best. But it's going to get worse before it's going to get better, and it's going to take years to clear a lot of these guys out, and that's why they're number 3, Walking Dead.
And The Walking Dead actually brings us to our number 2. They kind of go hand in hand to a certain extent. Malls, and we're talking about the enclosed regional and super regional mall. In our opinion, and not only our opinion, but in the consumer's opinion, um, this business model's run its course in America. It signified suburban sprawl and the consumption that went along with that. Uh, you know the American consumer, it definitely has changed their patterns significantly. You know, you could say, hey, Walmart made it really tough. Walmart and online shopping made it really tough for the Walking Dead of retail. In this case, yes, of course, the WalMarts and the online guys definitely, made it tougher for the mall. But the real big killer of the mall is the open air lifestyle center. You know, the open air lifestyle centers, they definitely offer a more palatable experience to the modern American consumer. You have the higher end restaurants versus the food court with the outdoor seating, and you have the trendy bars and anything else that goes along with more of a retail shopping experience. And they're actually taking away the inline tenants from the regional and super regional malls. Between that and the difficulties of the big anchors like the J.C. Penney's and the Sears, it spells doom for this concept. And the writing is definitely on the wall. When you actually look and see what is going on with these malls, they're not getting repurposed. Sometimes they're getting repurposed to lower end retail for a certain period of time, but a lot of times they end up totally vacant and dilapidated and get repurposed into something that has absolutely nothing to do with retail, like hospitals, like micro unit apartments in Providence, Rhode Island. I saw one in Missouri that was repurposed to 2/3 of a call center, and the last third was a mega church with complete with basketball courts and a big auditorium. So the writing is definitely on the wall here. The saving grace, obviously, if you're paying attention to earnings, especially for the REITs, would be the Simon Mall Group and the higher end REITs that own the better malls and the more dense and higher income areas such as Aventura, down here in South Florida, or Phipps Plaza up in Buckhead in Atlanta. Those malls are still doing pretty well just based on location and demographics of their clients. But the Suburban Sprawl Mall, the Midwest Mall, go on deadmalls.com and you can read stories of these things, for the past 20 years of just totally becoming dilapidated, and just the landscape totally changing. So
And there are a lot of malls that aren't, necessarily dead yet. That are kind of, I guess you could call them zombie malls as well. Um, they're out there, and people got listing prices. People are trying to make money, but we've seen some of these same malls. Literally, we'll have the same mall come in like 3 times to us trying to get sold. And it's just, we see them trade, 3 times within 5 years sometimes, and they're constantly taking a loss. So unless you know what your exit is on how you're going to turn this mall around, and it's probably not going to be going down the retailer list, another use redevelopment. Unless you got a clear exit, probably, I would recommend staying away usually. All right, number one on the list. No one guessed this right. The for-profit colleges. I know it's probably a shock to most, but it's for good reason. And number one reason why they're the top of our list is because they're toast. They're toast, guys. You got Congress and President of the United States and the media they all have a target on the back of for-profit college business model. Um, the issue is, so they received about 25% of all federal aid. Okay, they only enrolled about 10 to 13% of the student population. So automatically they're taking double of their share of the federal aid. Okay, out of that 10 to 13% of the student population, roughly I think what is it 45 or 50% of them actually graduate, which is extremely low graduation rate. And then they've got what was it, 47% of all of the student loan defaults are from enrollees of for-profit colleges. So that's kind of why they're toast. They got a target on their back. The reason why they're bad, real estate investments, they're usually on long-term leases, and a lot of guys are out there in the market right now trying to sell them on 6 to 8 caps. There's a lot of things you got to look at. Drake can fill you in more on that. And they also have very high end build outs. It's very compartmentalized, so it makes it, and obviously they're usually one tenant running off of 1 meter, so it's very difficult to convert it to another use. So you better pray that a charter school comes in, a well run charter school comes in and backfills it if Congress pulls the cord on Stray or another one.
yeah, these things, it's a horror story. It really is. And they've all been caught up in this. These guys have been getting sued over and over again by the Justice Department and states attorneys generals for tens of millions of dollars, especially, and it's really heated up over the past 5 to 6 years. Um, a couple things a couple names you should definitely know would be Senator Dick Durbin. It's his personal mission to clean this business model up. Um, these guys, a couple of the reasons why they were sued was they were taking all of that student aid that they were getting and using 25 to 35% of that to actually advertise and get more students in, generally during daytime television. And their average student age was about 35 years old. So you have a lot of folks going in, and I can talk horror stories all day. You have folks going into places like Full Sail University to get um, hip hop audio production degrees, and they walk out with $45,000 worth of student loan debt, and they don't get hired to be the next Timberland or Pharrell Williams. I mean, that's really what's happening out there with these guys. And right now, Obama actually appointed somebody in the Department of Education specifically to focus on for-profit colleges. There are regulations coming into play this spring, right now as we speak, which are trying to hold them to higher standards. Higher retention, higher graduation, and higher job placement standards. And so far, from the standards that they're kicked out, none of these guys are fitting the bill. So there's going to be a lot more closings. There's going to be a lot more bloodshed over this business model. and it's going to get reshaped. That doesn't necessarily mean it's going to go away. A lot of these guys have been around 30, 40 years. They weren't, massive student, federal student aid consuming machines when they first started, and they're probably going to revert to something similar to that again. We touched on that in the only saving grace we could possibly see in this business model. Some of them are actually partnering with some of the larger employers in America to basically, front their job training. Like we say it here, Strayer University partnered with Fiat Chrysler to train employees to just go out and automatically get their jobs at Chrysler. So obviously, that's going to increase the retention, graduation, and job placement rates. But that doesn't necessarily mean the scarlet letter is going to vanish on these guys. I believe 2 or 3 months ago, University of Phoenix, who's by far and away the largest of all of them, and most reputable of all of them. They were about 50,000 students short of their expectations last quarter. People are. It's a stigmatized business model. There's going to be a lot of closings, and by far and away, yeah. And one more thing as well, if these guys do not meet the standards that are being put out by the Department of Education, all federal funding is going to be pulled, so no students are going to be able to apply federal aid, which is their entire business model, to actually go to these universities. So again, they're toast, and this is by far and away number one on our series Dirty Dozen list.
All right, guys, that's it. Hope this was beneficial for everyone. Again, thanks for joining us. Feel free to reach out to either myself, Michael Jimenez, or my partner, Andre Quadrado. Thanks for joining us, and we look forward to your comments, guys.